Did you know that you could improve your credit score with one simple step? Before any big purchase, you should understand your credit score. What are the impacts of the choices you're making? Most of all, how to read a credit report. If your credit score is not what you were expecting, don't freak out. Watch this video until the end, where I will explain simple strategies to improve it. My name is Aguinaga, and I've been a real estate broker since I was 18 years old, and I personally have been involved in over 1,500 real estate transactions. For the past 6 months, I've been a part of a radio show with mortgage brokers Fred and Martin, and I've learned a lot from them. So today, I want to break down this topic and give you as much information as possible so that you can prepare properly for any purchases that you want to make in the future. Let's get started by explaining what a credit score is. Credit scores are a relatively recent concept. They started being used in 1989. Your credit score demonstrates how reliable you are to a lender, and anytime you want to get any kind of credit, that is the first thing that they're going to review. They want to see your track record. If you've been late on payments, if you've defaulted on payments, or if you've got a credit card that has a $10,000 limit on it and you're using $9,500 of it. Those are the type of things that will hurt your credit score and the things that lenders avoid. It's not just an individual credit card, but your overall credit utilization. Now that you know in simple terms what it is, let's go through the things that impact your credit score. First of all, utilization. Utilization is the debt to credit ratio. Simply put, if you have $10,000 available to you in credit and you were to use $5,000 of it, your utilization is 50%. We take the $5,000 divided by the $10,000, that gives us our utilization. It is typically understood that banks want to make sure that your utilization is below 30 to 33%. That is a healthy number for them. Next, payment history. Payment history comes down to, are you paying your bills on time? Do you usually pay before the due date or on the due date and not maybe a day late or a month late or 2 months late? If you're paying on time, these are all good signs for the credit bureau, and that means they're going to report a healthier credit score for you. The next important factor is the age of the account. And this is why people will tell you all the time, don't close any credit that you have. If you don't need the credit card and it's not costing you anything, just let it keep renewing, let it keep doing its thing. Because if you've had credit accounts for a long period of time, this shows the entire credit bureau that you are a strong payer and that you can maintain your healthy accounts for a long period of time. Next, number of recent credit checks. Now, the reason why this is important, and this really comes down to, are you looking for credit from different entities at a time? Because if you do a credit check on your own, that's not a big deal. But if you've gone to bank A, B, C, D, and you've asked for a loan from everybody, all of these hits tell the banking system that, oh, this person's looking for credit really desperately. They've gone to a lot of people for credit right now, and that'll start really reducing your credit score exponentially, depending on how many places you go to tell people like, hey, put the brakes on. This person is going to a lot of different places to try and get credit. There must be some sort of issue or problem. The next important factor is delinquencies. Now, if you don't pay your credit card for a long period of time, you're going to be delinquent. And what can happen through this is you might have to file for bankruptcy, you might have to do a credit reconstruction, stuff of that nature. So if you have been taken to collections or you've had to declare bankruptcy, these are things that are obviously going to negatively impact your credit score. Now, it's important to note that if you have had a bankruptcy, this doesn't mean that you will not qualify for any credit and that you will not be able to purchase a house. We have actually helped several clients purchase a property after doing a debt consolidation or a bankruptcy. We just have to make sure that enough time has passed since this has happened, and we won't be able to go to the institutions that you did the bankruptcy with. So if let's say that you owed money to RBC when you did this, we might have to take the mortgage to TD or to a different institution. Here's an important strategy to improve your credit score. If your payment is due on June 10th, that doesn't mean pay it on June 10th because it usually takes a day or two for the bank to process the payment. So you're always better off making sure you pay your debt a few days in advance in order to avoid any lateness on your payments. Another important factor is the age of your account, how long you've had these credit cards or any kind of credit. So if you have a credit card that you don't use much, don't cancel it. Keep it in good standing. It looks good on your credit report. Another trick in all this is to automate your payments. It's important to understand that for your credit report, there's no difference between being 1 day late or 29 days late. And this stays on your report for a very long time. So automating your payments is a great strategy to keep your credit score healthy. If you can't afford to pay off the entire credit card balance in one lump sum, that's okay. You just have to make sure that you pay the minimum on time. Keep in mind that the number of credit checks can have a negative effect on your credit score. This is specifically for hard checks from new potential creditors. If your bank offers you the option to view your credit online, this is considered a soft check and won't impact your credit score. For me, the simplest way to improve your credit score fast would be to use no more than 30% of the credit available on the card, wait to receive the statement, and then pay it before the due date to ensure it's paid on time. Talking about real estate, nowadays, in the current market, the minimum benchmark credit score is around 650. We can get a mortgage with a score between 600 to 650 as well, but the rate will likely be higher and it's probably going to be a secondary bank. If your score is below 600, you've got some work to do, and you should build a strategy in order to rebuild your credit. Thanks for sticking around till the end. I hope you found this video helpful in understanding how to improve your credit score. Remember, having a good credit score is crucial for making any big purchases, including buying a home. If you've enjoyed this video, please give it a thumbs up and subscribe to my channel for more tips and advice on real estate and financial health. Also, don't forget to share this video with anyone who might find it useful. If you have any questions or need further assistance, feel free to reach out to me. My contact information is in the description down below. Thank you for watching, and I'll see you in the next video.